Good morning, everyone. We're just waiting a few minutes to let some folks into the webinar, and we'll start in just a minute. Good morning, everyone, and welcome to all of you. My name is Bill Robinson, and I'm the President and CEO of ADA Practice Transitions. And I want to thank all of you for being here with us this morning. I know there were complications last week, and there were some technology issues we just weren't able to overcome. So thank you for your patience and your flexibility and for being with us this morning. I'm going to go through a few housekeeping items very quickly, and then we're going to jump right in because we have a lot of material to go over this morning, and I think it will be very helpful for you as you consider these critical questions around purchasing or selling your practice. So the first is that this webinar is being recorded, and it will be available afterwards through a link on our website and in our blog, so you will be able to access it afterwards. And for those of you who are on the webinar now and attending it live, you will be able to get CE credit for it. And instructions about how to get that CE credit will be sent to you next week after it goes through sort of an approval process. Those who view the webinar afterwards in the recorded version will not be able to get the CE credit. It's only available to those who are attending live. If you have a question during the course of the presentation, if you're not familiar with Zoom, there's a box on the bottom banner, usually is where it's located, for Q&A. And if you have a question, you can type your question in there. And if we can, we'll deal with it in the moment, in the middle of the webinar. If not, we will hold it till the end and either deal with it in the Q&A section or perhaps provide an answer to you and send it out afterwards so that we will get to every question we possibly can over the course of the webinar today. In fact, some of you sent questions in beforehand, and our presenter has worked the answers to those questions into the presentation itself. So if you've asked a question, sometimes the reason we're not answering it in the moment is because we know it's going to be handled a little bit later in the webinar. So, but we do encourage you to ask those questions. And in fact, one of the questions that came in early was from a participant who asked, what is the #1 resistance point from both buyers and sellers to the ADAPT concept? And what can ADA membership do to promote the ADAPT concept? I love that question. Thank you so much for asking that one. In terms of the resistance, what we have found is just that we really are new and different, and sometimes it takes folks a while to wrap their minds around a different way of doing things. We are not just an employment broker. We're not a job board or a practice listing site where we're just sort of putting things out there and then everyone sees it and can come in. It really is a different concept. And sometimes that takes folks a little while to get used to or understand what's different about it. In terms of that, the other thing in terms of resistance is not so much related to ADAPT, but just the current economic environment. So between the pandemic and the economy, everything is taking longer, whether that's finding someone who's a good match for you, and then going through the transaction of hiring an associate or selling your practice. Our recommendation is just be patient, where we think things are going to come back, but it is taking longer for everything to happen now. And I hope that makes sense to you. And then the final question, what can folks do to promote this concept? Send people to our website. Go to adapracticetransitions.com. We love the fact that folks are asking that question. We have lots of material and information there. And as I said, the blog does a good job of giving examples and talking through some of the details. And with that, I am now going to introduce our presenter for this morning. I'd like to present Rob Westhoven, who has a 20-year career with banking in Maine, and he has specialized in dental practice finance for the better part of the last decade. He's very active in the Maine dental community and works closely with practice owners and dental professionals all across the state. He recently served as a panelist for a series of webinars hosted by the Maine Dental Association. And over the past few years, Rob has helped develop a network of non-dental specific business professionals focused on serving the Maine dental community. So this group is recognized as preferred business vendors of the MDA and help support the dental community through a variety of channels. Rob, his wife, and 3 elementary school children live in Auburn, Maine, and he's passionate about helping Maine dental professionals realize their personal and professional goals by providing custom financial solutions for the practice, the family, and the future. We've run into Rob in some of the dealings we've had in Maine and found him to be very, very helpful around these financial questions. And so we're thrilled that he was willing to take the time to talk us through some of the details this morning. And with that, I'm going to turn it over to Rob.
Thank you, Bill. Appreciate you having me on this morning. Thank you for all that are attending. I hope this is an informative webinar for you. I know a lot of people have some questions about how to get their loans approved in the current environment, and we'll walk through some steps you can take to try to ensure a successful transition. And I think some general helpful hints on how to approach your bank and kind of talk through the general process. With that, I'll go ahead and go to the next slide and we'll talk about the agenda. So we'll do an intro, obviously. We'll do some typical financing scenarios, cover a few of those. We'll talk about sources of capital for the dental professional. We'll talk about how to prepare for financing discussions. We'll talk about what banks look at in evaluating their loan applications. We'll talk about some actual financing scenarios, some kind of real life examples. We'll address the questions that had come in as kind of, I've worked them into the presentation. And any that we didn't catch on, we will make sure to follow up and address those. And perhaps the most important part of the presentation will be kind of how to approach banking in the post-COVID era and some useful tips to kind of help you along the path of buying a practice. Go ahead to the next slide. So first, I'd like to introduce Androscoggin Bank. So we are a mutual bank committed to the Maine economy. We're a mission and values-driven company, local leadership. One of the things that really excited me about this bank, I've been here for about 3 years. I did work for a large, somewhat national bank previous that had a multi-state footprint, and the difference between a local mutual bank and a corporate stockholder bank is really who owns the company and kind of who the interest of the loans are kind of guided towards. So the difference between a mutual bank and a stock bank is that the mutual bank is actually owned by the employees and the clients that have deposits there, whereas stockholder bank is owned by stockholders and they don't necessarily bank at the bank. And usually the mission of the stockholder bank is to deliver value for stockholders, whereas the mission of a mutual bank is to deliver value for the member owners. So a little bit of a different model, a little different approach. The fact that we are a mutual and only serve the state of Maine, and we're able to develop a program specific for dental practices is something I'm quite proud of at our small bank, and I think kind of indicative of the way to do business in Maine. Androscoggin Bank's been around for 150 years. We're recently nominated as an Aon National Best Employer, and we do have a dedicated specialty group to cater to our dental practices. Go ahead to the next slide. We'll talk a little bit about that program. So generally, our approach to dental practice finance is very similar to our approach to banking in the state. Maine's a small business state, and we really are a small business bank. We love to keep small business in our healthcare system. I think there's been a general trend both on the banking side and in the healthcare side to consolidate and merge entities and become kind of larger, and there's not a right or a wrong to that, but I think that both banking and the dental industry have kind of experienced those pressures. The DSOs, typically a lot of offices. I think, the experience that you would have with with that generational doctor-patient relationship. I think in many ways, in the healthcare environment, the dental professional is one of the last semblances of the family doctor. I think, in the last 20 years, your primary physician, your primary healthcare physician, they're almost always a hospital-based employee. It's not there's not that close personal relationship between doctor and patient. And I think banking is kind of very similar. I think in many cases, the larger consolidations that have happened, what almost universally happens is the underwriting or the loan decisions are made out of state, out of market. The folks that are making those decisions don't have a personal relationship with the borrower or the doctor in your case. And if the loan officer that's working through the credit system that may or may not be in their backyard, if they're not communicating your vision, your philosophy, and telling the story of your practice, it's going to be very difficult to get an approval, especially in the current environment. So, our bank's philosophy is that, we lend local. We live and support these local communities. We want to be the bank for our doctors so that they can maintain that small business, that small personal relationship with their patients, and create that generational kind of relationship that we value from our clients, and we want to make sure we are able to help to support that in the dental community. We have some experienced dental business bankers that work for our bank, and it's all we do is serve the dental community in Maine. Go ahead to the next slide. So the typical financing scenarios that you'll run into on a kind of regular basis are maybe a practice acquisition, a buy-in or a buyout, general equipment purchases for those that are already in practice, real estate transactions that you could either purchase, expand, or in some cases do ground up construction. I'll talk a little bit about that at some point. There are some factors to consider when doing ground up construction, especially in the current environment. There's also the need for startup financing. Always a little bit more of a difficult discussion when it comes to getting bank approval. I think basically there are some different nuance to the startup financing. Is it a projection based where there's literally no patients today and we've got to build this thing? How long does it take to stabilize? I mean, typically, a general dental office, you would expect about 3 years to stabilize to full capacity with a single doc and a couple hygienists to really build that up to, kind of the average that you would expect to see for a single doc office. Specialty practices are a little bit of a different animal. I do have an example that we'll talk about later, but I did finance an endodontics office, and the explanation was, if I do my job right, I never see the patient again, and the referring doc sends me more business. So definitely a different underwriting model when you're referral based for your income versus actual created patient relationships. So we'll talk about a few of those things. Briefly on the specialty space construction, the cost to construct dental space is typically a little higher than the average office space. Could be just related to the plumbing. There's basically like putting a kitchen in every room, but it doesn't always translate to the appraised value, because you don't always with a lot of the specialty construction that's involved to set up a dental office. Your appraisers aren't always recognizing that value, which can cause some problems in the loan process, because you're doing an as complete appraisal. So you've delivered to the appraisal, this is the scope of my project, this is what we are constructing, this is what it will look like at the end, what will it be worth when we've done all of these things. There's a lot there's a lot that goes into creating one of those appraisals, And I think one thing I've noticed consistently in the last couple of years, actually, is that, in ground up construction for dental offices, the value is always, just a little below the cost to construct. And it has everything to do with the specialty work that's done because it's a dental office. So there's ways to kind of address that, but certainly something that's come up kind of time and again. Go ahead, Kathy, to the next screen, please. So the other thing that's, we should probably talk about are sources of capital. Where do you go to get financing to buy a dental practice? There's kind of you can almost look at it as a pyramid, because there's a lot of different places that you can go. And some of these places aren't the first place you might think. I'll kind of start at the local level. Some towns and cities have economic growth councils. They may be kind of a division of the Chamber of Commerce. And again, not all cities, but I happen to live in a market that has a couple of these agencies. And basically they're marketing the town to businesses that will potentially come in, and they offer to do smaller loans, usually micro loans, and sub debt financing. So what I mean by sub debt is they'll come in and participate with a bank. So maybe the bank doesn't want to do the whole loan, or maybe the bank's expecting you to come into the transaction with some liquidity or some of your own equity. And sometimes what we'll do is leverage some of those local lenders that want to bring business to the market, that's their mandate for their programs. They're fine with understanding that they're going to be behind the bank if anything were to go wrong. And obviously we have to talk about default scenarios, but they are an asset, and one that I think will probably be utilized a lot more in the current environment. They're usually a little more a little more willing to take risk than banks. They understand that they're not going to be in a primary position on collateral, and they're very flexible. And I think typically that's a great solution if you have just kind of a small gap for a down payment or something like that. But those agencies are available, and not everybody is really recognizing of that avenue to obtain some capital. So important, your local lenders should have kind of all of those agencies kind of on the speed dial. But beyond the local level, there are state programs in Maine. It's called the Finance Authority of Maine. They'll do very similar. They'll do larger transactions. They can do direct lending. They can offer loan insurance to banks if we wanted to take on let's say a startup office that was projection based, that didn't have a patient base for us to underwrite or financials for us to underwrite. Then what we might do is approve them based on the projections that we've gone through, and we would ask maybe the Finance Authority of Maine to give a loan insurance for that transaction. That basically allows the borrower a secondary support system for making what would be considered a kind of a more risky loan, and it allows the financing to happen. And typically that it's a short-term relationship on that loan insurance. So once the practice stabilizes, that loan insurance can be peeled off. It's no longer needed by the bank. Then they don't have to refinance the loan. It's a real attractive, especially short-term stopgap to get the bank comfortable with particularly a startup financing, or a transition that's maybe not given the best, put in the best light. And we'll talk about how the banks look at those transitions and how they kind of gauge what this thing will look at post-financing. So beyond the local, the state, there's also the Small Business Administration. So on a federal level, everybody's very familiar with SBA loans right now. We're not talking about the PPP loan. We're talking about true SBA 7A or 504 program financing. Briefly, difference between the two: 7A is typically for equipment, physical assets. The 504 program is typically for the real estate transactions. You can do acquisitions through 504 as well, But there's certainly different parameters for which of those two avenues you would go if you were looking at SBA financing, and again, be very specific to the individual situation, which would be appropriate. Beyond the government, there's private lenders, and I think what is going to be a major topic in the current environment, some seller financing. These are all means of basically so private lenders might include some of the equipment vendors that you're familiar with will have in-house financing programs. A lot of times that's leasing. If there's questions about the difference between leasing and lending, typically you're doing a lease to obtain 100% financing, and a loan you're obtaining something short of 100% financing. Banks that have dental specific lending programs are typically at lending 100%. Without enhancements or without the need or without going under a lease structure. And there's a couple of different reasons why a loan versus a lease might be more attractive. And again, I'm glad to talk about any of those things if that's another topic of interest. The next place you could obtain financing would be from a bank, and really the next three sources are all banks. You could get them from a commercial bank, which again, stockholder driven, usually a larger footprint, serve a larger market. You could talk to a credit union, not necessarily the same. They're not typically geared towards business transactions. They're very much, they do, especially in Maine, they do a lot on the personal side. I think not a lot of dental acquisition loans are run through a credit union. And then you have the community mutual savings banks. These are typically either a single state or serve a local regional area, and they're typically pretty community oriented. And again, as I've stated earlier, I think the main benefit and why I chose to work for mutual savings is we in the local market have a lot more control over the process, and I am able to personally deliver my my credit opinion and my client's philosophy to the decision makers at the bank. There's not a lot removed from the client discussion to the decision makers. It all happens in a very in the same area, the same market, and it's much easier, I think, to relay the general story of the client when you have kind of people that understand the market in the room. So we'll go on to the next slide. That's really your sources of capital, where you're going to get it from. I think one of the really important things to do, regardless of what you're considering, is building a team. I think if there's any advice that you take to heart from this presentation, it is you really want to have a financing team, and that team should include at least a CPA and a banker. You're going to need to involve an attorney, specifically if you're going to be transacting in real estate or forming new entities. Your accountant is going to be helping you to position your structure in as part of a tax planning strategy. I think, in the best case scenarios, your banker, your accountant, and your attorney are all working together. A lot of people have a lot of different approaches. I know of attorneys that really, they like to, they've got a certain way of doing things. And, if that seems to translate well to our dental clients who need kind of a specific approach from their attorney, we've got some in the state here that work with a lot of dentists. And as Bill had kind of mentioned earlier on, I've kind of taken it to heart to build a team of non-dental specific resources that include, obviously a bank. We have a couple of CPAs, an attorney. We've got some folks that are, involved in construction. We've got, insurance agents that primarily serve dentists. And we kind of use each other as resources. If somebody comes to me and says, hey, listen, I'm looking to buy a practice, I really don't know what to do. The best thing that I could do for that person is to introduce them to their accountant, introduce them to their attorney, introduce them to their insurance rep, talk about the things that they're going to need through the process. And any one of the folks that are involved in kind of the main community team, really understand what the other team members are looking for and the value that they bring to the transaction. I think a mistake that is often made, and I say this carefully, is in a brokered practice scenario, sometimes, the bank will be treated in somewhat of as a commodity. So here's a transaction, and we're going to send this out. Here's a potential sale. We're going to send this out to a bunch of different banks. We're going to get some term sheets. That might work really well. My advice in this current market is to have a personal relationship with your banker. He is your voice in the room. He is the person that is communicating your philosophy and the reason why the bank would need to approve your loan. Having a relationship with that person and having them spend the time to get to know you, get to know the business, and be the advocate that you need with the credit team on the bank, very important. And I think a lot of times, if you're treating your banking relationship like it's a commodity, like I just need the good rate, and whoever gives me the best rate is going to get this loan, or I don't have a relationship with the bank. This is what I need, and I'm gonna shop that to 5 banks. Again, that might work fine if you're a super solid, super strong credit, and there's no concerns. You might have 4 offers or 5 offers, and you can pick the best one. I've found with dental practice finance in general, there's a lot of things that need to be addressed in the room with the credit committee, and we'll talk about why in a couple minutes. But again, I can't stress enough how important it is to have your banker really understand your philosophy and be on board with kind of being your voice in the room. Go ahead to the next transaction. In preparing for a financing discussion, there's a lot of things that you're going to need, and not all banks approach this the same way. So we tried to be really comprehensive here with kind of the different things you're going to want to think about. If it's a startup, you're going to want a business plan. I could argue that you're going to want a business plan regardless of whether you're doing a startup or not, especially if it's a transition where the seller is not staying on for a period of time. It is very important to understand the philosophy of care from the person that's selling the practice, how that translates to the philosophy of the person coming in. What the bank's trying to kind of determine is, all right, I know what this business looks like under the seller, and it seems that it's a stable business and it's done X over a period of years, and we're comfortable that this is a nice practice. What happens? What's that transition plan look like? What is going to make the buyer able to continue on the trajectory that practice is on from a financial perspective? What services are you introducing that maybe are outsourced currently? Do you do some endo and currently all of those are being sent out? What you are going to bring to the practice, how you are going to replace that seller, all of that should really be articulated to your banker, and sit down and kind of go through, even if it's just a general look, today they're referring out this many procedures. I'm planning on doing those in-house. Let's talk about what that does to the practice afterwards. What we're trying to communicate with gathering this package is what is going to make you essentially give the bank the comfort to kind of recognize that you can pick this business up where this owner left it off and keep it running at the same levels. And all of the items that are on this page are going to help you tell that story. And again, and we'll talk about this, kind of later in the presentation, especially in the post-COVID world, the story is absolutely key. Go ahead to the next slide. Now, in preparing for a financing discussion, there was some questions on timelines. Every scenario is different. I actually met a dentist who I'll mention him in the scenarios as well, but he had $1 million transaction. It was $980,000 is what he was looking to finance. He was moving from lease space to another really nice new constructed lease space. He had gotten a term sheet from his current bank. The term sheet and a commitment letter are not the same things, and we'll talk about that as well at the end. But I think unfortunately, the conversation that had gone on with the bank was such that he needed about $1 million. They gave him an indication that, okay, we'd be comfortable with about that. He went ahead and kind of ordered some equipment, worked with the contractor, was getting the lease ready to go. And the bank came back and asked him to put $400,000 of his own cash into the transaction. That was not what he was expecting, and that was not, fair. He should have had a commitment letter before he kind of went down the steps, but he was given kind of the comfort feeling with his lender that they were going to come through with this financing. He went ahead and made the decision to go forward, and found out that it was going to require him substantially dipping into his savings account to kind of finish the project. Well, I met this guy on a Friday, heard the story, looked at the financials. I said, this is a really good transaction. We would do this for you, and you wouldn't have to bring any cash to the transaction. We closed the following Friday. That is not typical for $1 million transaction to close within a week. If you throw real estate in there, you're going to have the timeline certainly gets extended. But generally, the process of the loan of a loan application is the pre-qual period to the actual loan. You get a term sheet is kind of your estimate there. You're going to go through formal underwriting. You're going to get, that loan into the processor. You're going to lock price, deliver a final commitment letter. And at that point, you go ahead and hire the contractor and order the equipment. That's your final loan approval. And then your closing disclosures, move it to closing. And again, depending on if there's real estate involved, the timeline would increase. And the reason that is you do have title work that needs to be done, as well as the ability for the attorney to, you basically are going to need to have time to get an appraisal ordered and to go through that process. And depending on whether or not the appraisal, whether the market's busy, those are the factors you can't really control in the process. So, I'd like to say a real estate transaction that included a practice acquisition, you're probably looking at somewhere around 30 to 60 days to get that closed. And it really does, the factors that are out of your control are the timing of the title agent and the more importantly, the appraiser that can go, depending on what's going on in the market, how busy they are. I've seen appraisals that take 3-4 weeks to come back. That's just kind of a general approach. I would say if you had to tie me down, it would be about a 60-day process. But again, depending on real estate and what the general request is, can go a lot quicker than that. Go ahead to the next slide. So banks evaluating credit worthiness. This is something I think we got to spend a little bit of time on, because there's traditional bank underwriting method, and then there's dental lending, and they're not the same thing. There's a really important factor that needs to be considered when lending money to a dentist. But in general, the 5 C's of credit are condition, which is the purpose of the loan, and the market conditions, the industry information, that type of thing. The capacity, analyze the repayment ability of the practice itself. We're looking at cash flows. We're looking at your income to be able to service this debt. Collateral. This is going to be the main issue for dentists. Not all banks are going to recognize the practice itself as having value. For the banks that do not, most often a dental practice acquisition is looked at as an under collateralized loan, and which increases the risk rating, increases the pricing, and it often creates some hoops you have to jump through, either to get loan insurance through the Small Business Administration, more expensive financing through SBA or a local agency. But really, collateral is going to be a major issue, because not all banks are going to look at a dental office the same way. And again, it could be kind of the make or breaker on your kind of traditional approach to lending. The fourth consideration is character. That's just demonstrated responsibility, integrity of your actions. It's your credit score. It's your, I've heard it described, it's not if you can pay, it's do you have a mind to. But that generally, banks that don't really get to know their borrowers really well are probably looking at the credit score and kind of stopping there. But I think, the character to me actually does go beyond just a simple credit score. But the last is capital. So that's your skin in the game, your personal investment in the company. And, I probably have a little bit of a different philosophy on capital investment for a dentist than maybe some other bankers would. I see the years of school. I see the dedication, the willingness to build, $400,000 to $500,000 in student debt is not outside the ordinary these days to graduate dental school. I see that skin in the game, that investment in the personal, professional career. You are the business in most cases. You're incented to be a responsible citizen because of the work that you have put into getting yourself to this position and the debt that you've amassed to get to this position. This doesn't start to pay dividends for you until you've gotten kind of past your loan payments. Managing that debt on the front end is just really challenging for dentists because there's so much debt. But I think in general, it's your skin in the game as a doctor, as somebody that has put the time and money into the education. That is not something that should be overlooked in the analysis. And I think you're incented to kind of keep your name clean in the community and to be a positive influence in the community. And to me, that speaks volumes on the character side, but it also again, not always recognized for a dollar value, but it certainly is part of the conversation regarding your investment into the business. Go ahead to the next slide. So this one is basically, how do banks evaluate loan applications? And I think one of the things that we've got to really address here is the fact that not all banks are going to look at this thing the same way. Most banks are not looking at the goodwill or the practice value of the business to secure their loan. Dental specific lenders have developed internal valuation methods. We have one here at the bank where we will actually value your practice in-house. We will recognize that practice value as collateral for the loan. Essentially, that's the way we're treating it. And it will allow a lot more flexibility because you are the business. And that's, essentially a dental lender understands that the patient provider relationship is really the value there. We know what these practices trade for. We know what successful transitions look like. I think one thing that is really important to bring up in discussion with your bankers, especially if they haven't done a lot of dental practice finance, is the banks are all about risk profile. Everything's about risk appetite. How is the bank going to feel comfortable lending money to a dental office, especially if they've said now that there really isn't any collateral, we don't really recognize the business as collateral? Well, one of the things that really should be kind of in their mind is, the default risk for a dental office. This is from the SBA. This is a 10-year average, but offices of dentists with the 6th lowest risk of default for a business type in the country nationally, with a sample size of over 7,200 loans. So to be in the top 5, top 6 lowest risk industry, that's a huge mitigant for a bank's assigning risk to the transaction. That needs to be brought into the discussion. If your banker doesn't work with dentists on any kind of a regular basis, you're in a really low risk industry from a default perspective. That has to translate to a reduced credit risk for you. And I know that not all banks look at it that way. The other thing that I think is very important to consider is, dentists, especially in Maine, are the 5th highest paying job on average. So if your bank, or if the bank is looking to work with wealth and emerging wealth clients, why wouldn't we want to give loans to folks that are in the top 5 highest paying jobs in the state? So I think, you hear from a lot of traditional lenders that dental offices, there's no collateral, we need the SBA. We're going to need some loan enhancements. We're going to need loan loan guarantees, loan insurance. You're in the top 10 lowest default rate industries, and you're in the top 5 for income producing on the wealth side. Yeah, that to me is a very strong mitigant and absolutely needs to enter into the conversation. The other obstacles you're going to see in the financing discussion, You know, traditional collateral is going to come up if you're not dealing with a dental lender. There is complex revenue streams. You know, if the bank you're working with has not worked with dental offices before, they may have a lot of questions about, you know, kind of who's doing what at the practice, and looking at the production reports might be maybe not something that they're used to looking at. And again, some of the ownerships, there's some varying ownership, you know, kind of models out there. We do have a couple of, you know, we have a couple of scenarios to kind of talk about there. And there were some questions that came in live that'll talk a little bit about those. We'll talk a little bit about those varying ownerships and how to approach that. And the last bit, and again, very important, equipment valuation, real estate appraisal, enterprise valuation. If they're not a dental specific lender, they're not going to do internal enterprise valuations. They're not going to analyze the practice itself and essentially allow you to leverage that as if it were hard collateral. That's the specialty approach. Traditional approach, goodwill is an intangible asset, and it's not considered in the credit discussion. For a dental lender, that is the asset, so it has to enter into the discussion. If you're talking to a bank that does not recognize enterprise valuation as a source of collateral, then you're probably going to be paying more for that loan, because what you're paying for is the insurance or the enhancement that the bank is going to add to that. Often not even to the bank's own benefit. They're you know, that's an insurance paid to a third party. But what they're essentially doing is stating that they want this extra insurance because you don't have the collateral to secure your loan. And again, that is going to be a different story if you're talking to a dental specific lender. I think we can go to the next slide now. So I'm going to get into a little bit of examples now, because some of the questions that kind of came in over the phone, over the email throughout the week, really touched on a couple of important things that I think we need to consider. So the different types of financing scenarios that you're going to kind of see most often, there's a startup practice. You got a general dentist versus specialists, practice acquisition, partner buy-ins, and I think it's important to kind of touch on all of those. I think I'll talk first about this. There was a question that came in about a stock sale versus an asset sale. And I have to first give full credit. This is, I had to pitch that question to a CPA. He is one that works with a lot of dentists. So thank you, Mike Royer from Barry Talbot and Royer, for giving me this answer. But essentially the question that came through was, if I'm thinking of buying into a 2-doctor practice, one's retiring and the other who is staying, bought into the practice as a stock sale versus an asset sale, do I also have to buy in as a stock sale? And I thought that was an interesting question, and one that really has a lot of tax implications. So I wanted to hear a CPA view of that. And the answer, I'll just read verbatim, was, in most instances, an asset purchase is the most desirable method of purchase. In the case of an asset sale, a new company is formed and the new company purchases all the assets of the seller. The buyer owns the new company and has normally no connection with the selling company or the retiring doctor. When the purchase is structured as an asset sale, the purchase price is allocated to the assets of the practice and the asset costs are taken as tax deductions, lowering the taxable income of the practice. For dental equipment and furnishings, you can often receive a full tax deduction in the first year using bonus depreciation, or that Section 179 depreciation. You also have the option to write off over the normal tax life of 5 to 7 years, that equipment. So the portion of purchase price allocated to the goodwill of the practice, which normally has the largest amount of the purchase allocated to it, is amortized over 15 years. So allocating the purchase price to these assets allows you to recover the cost as a tax deduction every year, thereby reducing your income taxes each year. For this reason, the generation of immediate tax deductions, most practice sales, in fact, most business sales, are structured as asset sales. So when you purchase practice as a stock sale, the purchase price is allocated to the selling doctor's stock in the corporation. In that scenario, you do not recover any of the cost of purchasing the company until you've acquired the stock in the practice, presumably years after you years later when you either sell some or all of the practice. So in a stock sale, you get no additional deductions for the value of the underlying assets, similar to what you get in the asset sale, and therefore you normally pay more taxes every year. So on occasion, stock sales may yield a lower purchase price since they are considerable advantages for the seller. They get capital gains for the entire purchase price and a tax disadvantage for the buyer since they will pay more taxes due to the lack of tax deductions. So once a practice transition has started as a stock sale, it's very complicated and likely costly, but not impossible to have the next step in the transition be structured as an asset sale, because the assets are already in the business entity, which the doctors will own and operate. So again, it sounds like the asset sale is certainly preferable from a tax planning strategy, but the stock sale, in a multi-step process, may be a little more complicated to overcome and turn into an asset sale for that second round, but not impossible, and certainly something you want advice from your tax advisor on. That absolutely part of that team approach. You want to know exactly how your CPA wants these things structured before you get to a closing with a bank, and for exactly those reasons. I have seen practices where the tax strategy was not really, we'll just say, fully baked on the front end. And in year 3, when they started running out of their depreciation for the equipment that they had a significant tax obligation that a conversation with their CPA would have better prepared them for. We'll just say it that way. The other couple things that were mentioned there, we've got in a practice transition or an acquisition, you've got a lot of transition planning that has to occur there. The valuation is going to occur, whether that's done by a broker or by a bank or a CPA firm. But one of the things that you want to really talk about is what value are you adding as the buyer to this transaction? If you're coming on as an associate, are you introducing procedures that aren't currently in the practice? What is going to make you be able to kind of hit the ground running with either taking over full time for that selling doc or kind of buying in, which is kind of our third scale. There's a lot of different ways to approach this. I should probably pause pretty quick here for some questions on this screen. But I think, in general, there's a lot of different ways. Every situation is different. But I think kind of some of these key points that we've made here, if you're buying in with a partner, your philosophy of care has to match. You have to know what that person's bringing to the transaction as well. If you get into a scenario where it's very clear that one person's outproducing the other and compensation isn't adjusted that way, that's not a setup for success. So that philosophy of care and just really getting comfortable with everybody's role in that transition, that's keys. You don't want to have that anything kind of left to chance there. I've seen numerous scenarios where older doc has let someone buy in early on, and now it's time for him to retire, and it's the two couldn't be further apart on the same page. And I see I see that proper planning on the front end of that transition would have really avoided a lot of the issues that these guys are going through right now, and I can't stress that enough.
Hi, Rob. This is Bill, and we've got about 10 minutes left. So if you could go to the next slide, and then we've got a couple questions we want to address in the Q&A.
Sure, absolutely. So this is it, guys. So what do we do now that we're in the midst of COVID? And I did circulate to a number of banking professionals. I've got some. I wanted to get opinions from different people that would look at a loan application. So I've got our chief credit officer weighed in on this. Our head of commercial banking weighed in on this. I had an analyst, an underwriter, give me some things that they're looking for. So basically, I'll go through some of these points with you real quick. But keep in mind that this is really the time for you. You have to have a really strong plan going into a financing discussion right now. So one of the things is, capital's precious. Banks have a lower risk appetite for lending, and they're charging higher prices to make loans right now because of what's going on and the uncertainty in the environment. You have to be able to communicate your story, know and quantify how your business was interrupted and impacted by COVID. But more importantly, tell the story of the practice. You really have to make sure that your lender is able to communicate to those credit folk who are definitely nervous right now about all the things that are going on in the different industries that are affected by COVID. But you have to have somebody that really has a strong understanding of what your practice brings to the community and what you bring to that practice. And those are the types of conversations, and that's where you want to spend your time. Really make sure that you've covered your bases in those discussions. From the credit perspective right now, they're going to be looking at leverage, and by leverage we just mean maintain cash reserves to whatever ability you have to do that. I know on the front end of a dental career, there isn't a lot of liquidity. You've got a ton of student debt. If you've bought a practice, you've now taken on the debt of your bank debt. You've got probably pretty good, strong cash flow, which is why people would do that in the first place. But you don't want to over leverage. This is not the time to be building the Taj Mahal practice with the Shark Tank in the waiting room. You want to maintain your reserves, and we do need to kind of see how this affects the industry, over the coming months. I think we've had really positive signs with some of the practices that we've worked with in Maine and what's happened since things have started to open back up. So we're feeling pretty good about what's going on right now, especially in Maine. But again, you have to take the time to ensure that you're communicating your plan and that you're giving yourself the best chance for success by ensuring the credit folks have a good understanding of what you're trying to achieve here. And really, really important. And one thing, again, I can't stress enough. There was a question that came in. It was a financing scenario that I had never even really heard of before. But it had everything to do with essentially the seller understanding that the buyer wasn't going to be able to get financing, and essentially allowing them to do a seller note where the compensation was going to be based on the next year's production. I'm hopeful that we don't have to get into scenarios where we're getting that creative with our structures, and that the banks are stepping up to kind of support their dental clients. But having the ability to have the seller involved in your discussions, more important than ever. If that seller is willing to take on some of the debt or a seller note and hold back, so you don't have to have the bank finance everything at the closing table, that's going to make the bank feel a lot more comfortable. It's going to keep the seller somewhat involved. In many cases, it's an advantage to the seller because they don't have to claim the capital gains from the sale of the practice in the tax year that it happens. If you pay them over a period of time, they'll actually, depending on what you agree to for an interest and for a structure with them, often they'll actually be making money, and again, not having to pay the taxes on the total, not up front. So I think if you're finding that the discussions with the banks are just a little tough, you might find that working with that seller to come up with a kind of an owner-seller structure that allows for some flexibility and maybe reduce the amount that you're asking for the bank. I think those are the types of things that are going to increase your chances to get a loan approved. And again, the statement at the bottom was one that we really believe in here at this bank, and that the key to overcoming the challenges is to work with a bank that understands the nuances of dental lending, and believes in and is committed to the industry. We believe in the industry. Life's going to get back to normal, and we're not going to waver in our commitment to our clients when they need us the most. And I think that's the approach that we're hoping that most banks will take in this space. And if you were a dental specialty banker before this transaction, your clients need you even more than they did before. So we've got to step up.
Thank you so much, Rob. There's a question that came in that says, is there any data to suggest that dental offices are higher risk to default since the changes through the pandemic. Higher PPE cost, aerosol risk, seeing less patients, et cetera. Let me give an initial answer, and then I'll ask you to chime in and see what you think. But for all the folks who are on the webinar, I encourage you to go to ada.org and then navigate to the Health Policy Institute. That's Marko Vujicic, the lead economist for the ADA. And actually, there are a number of encouraging signs. Marco's been running a survey with a lot of respondents every 2 weeks since the beginning of the stay-at-home orders and the declaration of the pandemic, and looking at things like, as dental practices open back up, how much of their patient volume is coming back in and how much of their revenue is coming back in. And he's been asking that same question and documenting it every 2 weeks. That data is available to everyone. So you can go there, you can download the slides. There are webinars where Marco has talked about it, though the data changes every 2 weeks. But that goes back to Rob's earlier point about telling your story. I think there is a story to be told around how dentistry can and will rebound in the midst of this, these bizarre, chaotic conditions. And there's some data to back that up. So I encourage you to go there and look at that data and use that as you're building your story for your financing. Rob, do you have any additional thoughts on that?
Well, I typically don't argue with chief economists, so I try to leave that. No, I think you're spot on, Bill. I think it's kind of too early to tell exactly what this looks like. I don't think that banks actually are necessarily knowing what questions to ask when it comes to that particular topic. I think time will tell on that one. I agree. I think I've heard the discussion about the aerosol being an increased risk, and I think a lot of that's going to be vetted over the next couple months. Generally, so far, it seems that the practices, I mean, I've heard the term 75%, kind of capacity when they're first getting back up and running. There's absolutely going to be people that are not willing to go into a dental office right now, that are they're staying home until someone tells them there is no more COVID anywhere. But I think, generally, we don't know yet, and there isn't, what you're telling folks to monitor and to be able to, kind of articulate in the room with the banker, definitely leverage your resources, use those ADA resources to kind of answer that question. All the banks are going to be monitoring, the portfolio of clients they have currently, and looking at their financial capability and what those interim statements are looking like after the practices have reopened. We've seen some positive signs here in Maine, that things are getting closer to that V shape that we want to see for the recovery. But again, I don't think all of those things are known yet, and I think that there's going to be a different answer depending on which bank you talk to.
Yeah. Great. Well, thank you so much, Rob, for your expertise and your time this morning. I hope that was helpful for everyone. Just to remind folks, the recording of this will be available, and we'll send that information out to you. And actually, when we send the follow-up to this, we'll include a link to the HPI data so you can get there very quickly and easily. And with that, we are right at the 1 hour mark. And so thank you so much, Rob, and thank you for everyone who attended. Hope this was helpful. Have a great day, have a wonderful weekend, and hang in there in the midst of these difficult times. Take care, everyone.
Thank you, guys.